Today we're going to talk about taxes. I have a CPA or a certified accountant here with Nima Rezaei, and he's going to tell us about all kind of information that is important for you to know as a father, taking care of your family. But really quickly, Black Dad Brand is about four main areas: parenting style, reproductive health, relationship and communication, and of course, career and finances. So in following along with our career and finances, it's important to understand taxes and how it impacts our ability to provide and support our family. And so with that being said, Nima, can you give us a quick introduction to who you are, what you do, and how the information you're going to share with us today is going to be important, helpful for Black fathers in taking care of their families?
Yeah, thanks, Jamil. Thanks for having me. So my name is Nima Rezaei. I'm a CPA in California. I'm licensed to practice public accounting. I also hold an MBA from State University, Sacramento, with an emphasis in accounting. So I'm pretty much all in on the accounting side. Taxes and accounting is pretty much all I do. I think that this is a really important subject, especially for minorities and especially for Blacks in particular, because when it comes to like the advantages of home ownership, the advantages of retirement planning, the advantage of generational wealth, are something that unfortunately not all have access to that knowledge and that information, and the positive repercussions that comes with playing those games and involving yourself in those strategies. So I think it's important that we at least understand them to make an informed decision.
Well, excellent. I want to jump straight into some of the questions that I have for you today. And one of them is starting off with, what are some of the key deductions or credits available for families on their tax return?
Yeah, so back to what we were just talking about, as far as credits are available, it really depends, right? I mean, if you're a business owner as opposed to a non-business owner, you have a lot more flexibility. The benefits of a non-business owner's non-reimbursed employee compensations were removed with the Trump tax law, but nevertheless, there's still significant tax strategies. One of the ones I want to touch on are the advantages of home ownership. I mean, what it really means to own a home and how it can benefit you through generational wealth. And a lot of people don't know this, but if you have a mortgage on your home, and a lot of people try to avoid the loans because it's mortgage interest. Well, the mortgage interest is likely going to be deductible, at least for the first first half of the loan. And you can take a significant credit deduction and build generational wealth to the point where you can hopefully down the line have a house paid off and possibly purchase another home and make it a rental property and pass it to your kids and just pass it on to generational wealth. And that's something that I think that a lot of people are failing to understand, the benefits of home ownership. It's much more beneficial than renting, for sure. Regardless of the market, generationally, long term, it's better to own.
One of the other questions I have for you is can you explain how the filing status impacts tax liability as a family?
Absolutely. So first of all, a couple of things. The first of which is a standard deduction. The standard deduction is going to vary depending on your filing status. If you're single, if you're head of household, if you're married, you're going to get a different standard deduction. That's the first point. Second, your tax bracket is different, where the tax bracket of a single individual will increase much faster than one who's filing as married. So not only do you get a greater standard deduction, but dollar for dollar, your tax rates are going to be lower when you're in one or the other categories. Obviously, it's best to be married. That's the best filing status. Then the next one is head of household, meaning you have at least one qualified dependent. And then ultimately the third one, which is single, which really all you get is the standard deduction, and it's kind of like the least desirable filing status.
Wow, interesting to know. The other question here, are there any changes in the tax laws this year that could affect the family's tax situation?
Yeah, so the last couple of years, we've really gone through a transitional period. As maybe many people know, there was a Trump tax law that came into effect, which sunsets in 2025. So we're going back to the 2017 rules. So there's a lot of changes. But a lot of the new laws that have been in effect the last couple of years have been in direct response to the Trump tax law. One of them is the AB 150, which is what we call as a pass-through entity tax. So if you have a pass-through, then you should talk to your consultant or CPA and see how you can benefit from the AB 150 and have your corporation or your partnership or your pass-through pay your state taxes on your behalf and get a deduction. These are steps that some states, including California, took in response to the limitations placed by the Trump tax law. That's number one. Obviously, there's also numerous tax advantages laws that came into effect with COVID. The ERC, employee retention credits, PPP loans were processed. There was a sick family leave. There was a ton of credits that were passed out during COVID that people could benefit. Again, a lot of them were designed for like business owners or at least sole proprietors, but people who are simple employees can also benefit from some of those as well.
I think it's important for those. You talked about being a sole proprietor, and not a lot of folks understand that their side hustle or their business or what they do, whether that's childcare, braiding, or photography, whatever it is they do on the side, can be considered sole proprietorship and take advantage of some of these new tax laws that you're talking about. Can you first break down the term, what a sole proprietor is, and then maybe go into, again, how people can take advantage of keeping receipts or making sure that they provide the information to their CPA so that they can get those tax returns or those credits and write-offs?
Yeah, sure. So everybody defaults into what we call a sole proprietor. A sole proprietor is someone who's operating as a business, however small, and operating under their social security number. So hypothetically, let's say I start a business detailing cars. I file nothing with the state, or I'm just detailing cars. By default, I'm a sole proprietor, and I'm supposed to report my income and expenses on a Schedule C on my 1040. Then the next one, obviously, is an LLC. That some people can become a single member LLC. Then there's a multi-member LLC. Big difference between the two. The exact difference is probably beyond the scope of this conversation, but these are also for different type of entities. And finally, then you're looking at like S corporations, C corporations. Those are also different type of entity filing status. But the point is, everybody defaults into a sole proprietor unless you take steps to get yourself out of that. A sole proprietor means, hey, I'm a sole proprietor, sole owner, working under my own social security name, or under my own social security number. And that's what a good vast number of businesses are. They're sole proprietors. So if you do detail cars, if you do hair, or even if you tattoo or whatever it is, if you write books, you default into that automatically unless you take steps to opt out of that. If that makes sense.
Yeah, I think there's some apps out there that really make it easy for your CPA to take account for the things that you're doing. I know there's one, QuickBooks Self-Employed, and there's a new one that I think I just heard about that I thought was really good. It's called Keeper. And so what they do is they say, okay, they're attached to your bank accounts. They track what you're spending on. And then in the app, you can say, hey, this is a business expense. This is a personal expense. And so when it comes to keeping all that data and being able to give it to your CPA, it makes it easier for that person to assess what you can write off at the end of the year. And I think some of us may, for the first couple of years of my businesses, I would go through and do all the stuff. And then I'm like searching through all my bank statements and receipts, trying to find evidence of what I want to write off. But I think if we just use the apps, it would be very helpful and easier on the person to get those write-offs into the future. But my next question is, how can we as fathers optimize our child-related expenses such as childcare, education, for tax purposes?
Yeah, so good point. Obviously, childcare is childcare, right? If you have a qualified childcare, as in somebody who's actually a legitimately business, they should give you a form at year end that gives their name, their address, their EIN, and the amount of that you paid them. That is, of course, deductible. A portion of it is deductible on Form 2441 when you do your taxes. There's some restrictions to that. For example, both parents have to work. They're capped at a certain amount, but those are the general things. Regarding education, obviously there's the American Opportunity Tax Credit, the AOTC, and then there's a Lifetime Learning Credit. The difference is that the American Opportunity Tax Credit is a more beneficial credit. You get a higher refundable and non-refundable credit because of it, but there are restrictions to it. For example, graduate students do not qualify for American Opportunity Tax Credit. They have to take the lifetime learning credit. So, if you are going to university or you're like a freshman in college going to a community college, you can not only get the BOG, but you can also take these credits as well, which is something that I know for my parents overlooked when we filed when I was a kid. But that is something that you should finally look into. Finally, another one that I wanted to talk about is a 529 plan. Now, what's a 529 plan? A 529 plan is essentially when you go and you take money, you contribute it into a 529. Now, a 520, the contribution itself is not deductible, right? This is post-tax dollars we're contributing. But the good thing is when you pull the money out, if the money is used for qualified expenses, it is not taxable. So you can put in 5, then 10 years down the line, pull out 15, and the difference, that $10,000, will not be taxable to you, assuming you use it on qualified expenses such as tuition, books, etc., etc. And obviously, there's the BOG waiver as well for college students. I mean, they have to be within certain income limits, and there's some restrictions, but it's definitely something you should look into, as well as FAFSA and all the other ones that you traditionally hear about when you go to like local colleges.
I want to research this, but I do want to also make our viewers aware there's an opportunity in the plan. I think if your child was born within the past year, California gives you $100 to start a 529 plan for your child. I had the information, but I don't have it in front of me. So folks, go out there, do your research, see if you can sign up for a free $100 to start your 529 plan. As I believe as soon as your child has their birth certificate, you can start this 529 plan. My wife and I were both adamant to start one. In fact, my mentor, as soon as both of my kids were born, sent us a check and said, you will put this into a 529 plan, because he believes in the system, believes in the idea of preparing for your child's future and education costs. And so this is a great way to ensure that you are putting funds aside to support them. So my next question here is, what documentation should we maintain to support our claims for dependents and related deductions?
Well, the dependence credit is, like I said earlier, they should give you a form that essentially is your receipt. But, if you want to take a step further, I would say make sure you pay them, in non-cash, pay them in check, for example, or even ACH. That way you have some sort of record paying the provider the amount that you've paid them over time. They're giving their receipt is probably going to be sufficient, but if in case of an IRS audit, it's always good to have more evidence than not. So if you have the receipt and you have the checks, payable to Jamil's daycare, then that's even stronger evidence to basically push back against the government and prevent any type of additional liabilities being assessed.
One of my favorite books is The 7 Habits of Highly Effective People. And one of the key principles of highly effective people is to begin with the end in mind, right? And so for many of our viewers, you may be a first-time dad, your kids are really young. And so to apply that concept to begin with the end in mind, it goes into my next question that says, are there any tax-efficient ways to transfer assets or income within our family? And I'm thinking about, like, maybe you own a home, maybe you own a business, and you want to, you're in your mind, you're thinking, I'm going to build this up and build this asset so I can give it to my kids. But if you do that incorrectly, you're also handing your children a large tax bill, like transferring your home into their name and not doing it the right way. So can you tell us, like, what's some of the tax efficient ways that a person can make the necessary steps now, so when it's time to transfer those assets, it's done in a way that protects the family?
Yeah, sure. So first of all, they say that if you own a house, you should own a living trust. You should have a living trust. And the reason they say that is because it's, in case of death, it's a lot easier to deal with, with a trust than it is to deal with probate. So think of that as a general rule. If you own your home, you want to have a trust. Otherwise, you're going through probate, you're dealing with courts, which means more cost, more money. Second, true story, I had a buddy, his parents owned a house in San Francisco, and she essentially signed over the house to him, and I almost freaked. Why did I almost freak? Because it's a question of basis, right? A gift is much different than an inheritance. The basis of an inheritance is much more beneficial to the recipient than a gift. Because a gift, the basis is transferred. So if my basis in the property is $500,000 and I sign it over to my kid, well, guess what? Their basis is now $500,000. So if I bought it 20 years ago and I gift it to you now, guess what? It's still $500,000. Now, the basis when it comes to inheritance is fair market value. So if I buy a house 20 years ago for $500,000, now this house is worth $2 million, and I die and I pass it on to my kids, their basis is not $500,000, but it's $2 million. That is a significant difference because most times they could turn right around, sell that property without incurring any tax liability whatsoever. This is essentially what a lot of affluent people do. They get these rental properties, 8, 9, 10 of them or more. They depreciate them over year, over year, over year. They don't pay any taxes. And then when they die, they give those properties to their kids, and all their kids get step-up pays and essentially pretend like the whole thing is brand new. It is a tax loophole that is essentially designed for people who are affluent, and there's no reason why we can't play these games ourselves. We cannot participate in the same game. So to answer your question, inheritance is probably the better way to go. Gifts are obviously allowed. There's a $15,000 exemption. Anything more than that, you're not going to pay taxes, but you do have a filing requirement technically that you should be filing. But if you're going to transfer a significant asset like home, real estate, something significant, it's much better to do it and through inheritance than it is through a gift.
Thank you. Yeah, I mean, you kind of answered my next question, which would have been, advise on the implications of financial gifts versus inheritance in terms of taxes. But you're right. It's important, folks, to go out there and check out Living Trust. I actually just started one myself. My wife and I, we use the website called Trust and Will, or Will and Trust. But there's still other implications in terms of making sure that trust can be utilized, like making sure that your house, that you change the deed to be the name of the trust. And so there's components to it, but I encourage you to look into that. There's a ton of research out there, but here we just want to make sure you're aware of those things and what to look for. Now, my next question is, how should we handle taxes if we have income from multiple sources? Like if one parent is self-employed and may have a business or may have a corporation, like there's a variety of different streams of income. What general advice might you, or not advice, or knowledge should we be aware of in that situation?
Well, I mean, situations like that, I would say make sure you have a good CPA, right? Because there are different sources of income. Some of them may be capital gains. Some of them may be passive income. Some of them may be active and ordinary. It gets tricky pretty quickly. But if you get a good CPA, I think they'll be able to assist you in the process and the overall strategy of loss harvesting, for example, for capital gains. Suspended losses, and the QBI is a new one that a lot of people can take advantage of. If you have a qualified business that's making money, there's a way, for example, to aggregate them and still get a credit where you would otherwise not. There are numerous strategies, but if your income, your tax profile is anything besides like a W-2 and a little bit of interest income, if you're getting K-1s, capital gains, you should get a good tax practitioner and work with them. Absolutely.
So for folks out there who are, considering adopting a child, or maybe they're getting married and they want to, adopt a child from a previous relationship, what type of tax considerations should that individual think about or be aware of if they are now going to be taking on the responsibility of a new child?
Well, good point, right? So first of all, if you're adopting a kid, it should be out of love, obviously. That's the first and foremost thing we're looking at. But there are tax benefits as well. I mean, obviously, if you adopt a kid, you can claim that kid as a dependent. Right now, if the kid is below a certain age, you'll get $2,000 child tax credit. If they're past that, then you'll still get $500. A lot of circumstances, it can take someone who's filing as single, and now they have a dependent, now they're HOA, HOH,
Mhm.
right? So that is an advantage that also comes through. And finally, is adoption credits, right? I mean, the rules of adoption credits are kind of tricky depending on, if it's a national kid versus foreign kid, if it's a handicapped kid versus non-handicapped kid. But so the rules get pretty complex pretty quickly, but there are tax credits available to help you cover the costs associated with adoption, and then possibly more as well to help you with the transition of moving a kid into the new home. Beautiful thing, regardless of the tax credits, but the fact that the tax credits and strategies are there is certainly an advantage.
So we live in Sacramento, and this is a hot market when it comes to real estate, both buying. I think someone said that Sacramento is about 10 years away from meeting the need for all the folks who are moving here. And so some folks are in the process of selling, significant assets like a home. And I'm just wondering, are there any like significant tax or potential tax consequences of selling a property that someone should be aware of if they're now going to get a significant increase of funding from the sale of their home?
So the sale of your home is generally tax exempt, right? If it's your primary home and you've lived there for X amount of years, being 2 or greater, and it's used as your primary home, then you get what they call a Section 121 exclusion. And it's either $250,000 or $500,000, depending if you're married. And even if you don't live there 2 years, but you're forced to move for work or something else, you still may qualify for the exemption. So it's a huge, again, it goes back to the power of home ownership, right? Because you can get a home and sell it, and essentially it'll be a tax-free transaction for you. But generally speaking, though, I mean, like you said, real estate is a hot market. It is going to be a hot market, and I think that the 2008 2009 burnout left a lot of people with a bad taste in your mouth. That was an anomaly. I think that in the long term, you should all the power of owning your own home and having your own piece of land where nobody can come and tell you what to do and move out and raise your rent, I think is a huge advantage. Not to mention the fact that, as long as you have that mortgage and don't refinance, your monthly payments won't go up. So imagine if you buy a house and for 30 years, you're paying the same mortgage every single month. If you rent for 30 years, I can guarantee you they'll raise your rates at least 29 times. So again, huge advantage of being a homeowner versus renter. It's hard to get in the market, especially in this day and age, but strive hard because it's worth it, and your kids will appreciate it. Absolutely.
Great long-term decision. Are there any other rules? I want to go back to this. Any other new rules around the child tax credit and recent changes that we should be aware of?
Regarding the child tax credit, there was a bunch. I mean, like last year, they were basically giving people half of the child tax credit in advance. They were giving about
Right.
$1,500 in the hand. They bumped it up from $2,000 to $3,000. There's a lot of them that were in effect at the time for the child tax credit. Someday, like I said, they raised it and then they made it accelerated. But as a whole, though, what you're looking at is a credit for kids of a certain age below, you get like $2,000, and past that certain age, you're looking at $500. So not a huge thing. It's significantly different, if you recall, from the prior taxes before Trump tax law, where you would get an exemption on top of the child tax credit. We're not getting those exemptions anymore. If you recall, if you compare the tax return from 2015 versus 2020, it's going to look significantly different. Under the old law, the children having each additional dependent was more beneficial to you than it is nowadays. But nevertheless, it's still beneficial to have children as dependents. For child tax credit,
So I think,
but not just child tax credit, but it can trigger the earned income credit. It can trigger lower tax rates and everything else that we deduced earlier.
Think about like how detailed this information is. It's so much to be aware of. Can you tell us a couple of ways that we can ensure that we're in compliance with the tax regulations while managing, the family's finances? I mean, ways that we can think like, okay, during this time of the year, you need to make sure that you're either gathering up your information or taxes are due, or things like, ways that we can make sure that we're staying on top of, paying taxes or what we can write off? Like, what would be helpful for
Yeah.
us to know?
Good question. Good question. So first thing I want to clear any misunderstandings on this. Some people say, "Oh, I filed an extension, so I don't have to pay in till October." That's not how it works. An extension is an extension to file. It's not an extension to pay. So if you extend to October, but it turns out that you owed, you're going to be facing penalties and interest from April till October. Very, very clear about that. Okay. A lot of people have a misunderstanding. An extension is an extension to file. It's not an extension to pay. Number one. Number two, I want to talk about estimated taxes. So what are estimated taxes? Estimated taxes are essentially taxes to cover the payment requirements of people who either don't withhold on their W-2 enough, or they have sources of income that don't necessarily withhold. For example, a sole proprietor. Or if you're a sole proprietor and you don't have any employees, you're not going to run payroll for yourself. You're a sole proprietor. Everything's reported on the Schedule C. So as a result, there's nothing paid to the government all year. Well, if you do it that way, you will face a penalty at year end, because the government doesn't want all their money in April. They want their money on a timely basis. So adhering to an estimated tax payment schedule is very important, because it can save you penalties and interest come April. If you have those requirements, you want to make sure that you pay them. Otherwise, some people say, "Hey, I'll eat the penalties. I don't really care." You can do that, but you have to know what you're doing, and you have to make that informed decision. You don't want to make a decision not understanding the implications of it. Regarding everything else, businesses, like you own like a pass-through. Remember, your pass-throughs are always due 1 month earlier than individuals. So generally speaking, you're looking at March 15th, and extension, you're looking at September 15th. They're not due. Their penalties for filing an S corporation late are pretty brutal. About $200 per partner per month, per shareholder per month. So you want to make sure that, if you own a pass-through, you want to make sure that your accounting records are compliant and they're complete, and you want to make sure you get them to your tax practitioner in a timely manner so that they can get the filings. Even if you have to extend, you still want to make sure that you have enough detail to the point where you know whether or not you have to make a payment with extension, which is what will happen a lot of times if you end up owing.
So my last question deals with medical taxes, right? Or I'm sorry, medical expenses, and how a family can properly report, deduct medical expenses for the family. And that's something that, a lot of families are dealing with, the rising cost of medical care. Someone gets sick, or you got things to deduct, and it becomes a real issue. And I know there's a variety of ways in which people are receiving medical care, whether it's through a state plan, their job, or the medical expense option. Can you tell us a way that we can start to look into how to properly report and deduct medical expenses when it comes to taxes?
Absolutely. So first and foremost, you don't get a deduction for medical expenses if you don't itemize. If you take the standard deduction, then you don't get medical expenses, period. Right? It goes back to the home ownership, because if you don't own a home, you're most likely not going to benefit from your medical expenses, your charity, any type of gambling losses and things like that. You're not going to benefit if you don't itemize. So first of all, you have to itemize in order to get a medical deduction. Then after that, you're looking at the threshold of 7.5% of your AGI. So if your AGI is $100,000, then the first $7,500 is not taxable. Anything above that becomes a tax deduction on the Schedule A if you qualify. So
what AGI is adjusted gross income, right?
That's right, sir. AGI stands for adjusted gross income. One option that you may want to consider is contributing to an HSA. So an HSA is a health savings account where you can contribute money to that and take a tax deduction for it. And the threshold varies depending on age, and you're married or not. But long story short, let's say you put $4,000 in the HSA in 2022, and then in 2023 you have some medical expenses. Well, you pull the money out of that HSA and cover your medical costs with it. And then the HSA is a deduction. So when I give $4,000 to the doctor, or when I give $4,000 to the HSA people, then that's a $4,000 deduction I get. And when I pull the money out, it's not taxable. So it's essentially a way of making sure that your medical expenses are deductible regardless of whether or not you itemize. So if you don't itemize, you don't benefit unless you take this HSA route.
Well, you've given us such great information today. I think it's incredible. Folks, check in, do your research, do YouTube, Google, find this information, but most importantly, confirm all the information that you're looking into with a CPA to ensure that you're doing the right things. Be proactive. Don't wait till the end of the year. Don't wait till it's right before it's time to file. Be as proactive as possible in terms of, gathering all your receipts, your information, asking questions, checking in. I mean, Nima is my CPA, and I'm always sending texts and asking questions and trying to get information to make sure that I'm in compliance. And so he and I will have more to talk about that. And hopefully we can have you back, Nima, to give us more information. I think, we're just scratching the surface of what an individual needs to know when it comes to preparing for your taxes. So if folks want to get in touch with you and learn more about your services, how can they find you?
Thanks, Jamil. So you can find me on my website, which is nimacpas.com. Pretty straightforward. And I really appreciate you having me. I believe in the movement. I believe in the ownership and the generations that have come. And I'm just honored to be here. So thank you very much.
All right, folks, check us out on all of our social media platforms, our website. We're constantly growing with content. And so until then, we look forward to seeing you on the next episode. Take care.